Hey guys! I'm Dr. Lydia Virginia Woodruff and I wanna talk to you about what makes the stock market moves. What you need to know before investing into the stock market. The goal in this videos is to help you understand the 5 major factors that you need to know before going into the stock market, which in turn influences stock prices, so next time when you see the market move you will understand what's going on and hopefully make more informed decisions. If it's your first time to my channel, make sure you like, comment and subscribe button and turn on your notifications. As you might have seen this week, the market can be a crazy place and that scares a lot of people away from investing, but ups and down in the market are normal, nothing goes up straight line, so it's too expected. The key is to take the emotion out of it and keep a cool, calm head and position yourself to weather any market downturns. I'm gonna explain the 5 major factors that moves the market. When the stock market is going up or down, you can be sure it's due to one or more of these factors. The first is economic growth or development, or the lack of it. Stocks are pieces of ownership and companies, so when the economy is growing, that means companies' sales and profits go up, and that makes stock prices go up. If the economy is slowing down, that means less spending, less jobs, lower companies' sales and profit, and does lower stock prices. So the stock market is directly linked to the growing and the shrinking of the economic growth. So how do you know the economy is growing or not? The answer is by looking at economic data. The market reacts to data releases such as unemployment rates, non-farm payrolls, GDP, PMI, retail sale and a whole lot more. I just think the most important and the best way to stay on top of data releases is to use a website. I like forexfactory.com, and you can stay on top of what's coming out each week. Of course, it's not always like this because there are other factors in play. Which brings me to the next factor. The next factor is geopolitics. We live in an interconnected world, so things like natural disasters, earthquakes, wars, international relations, diplomacy, oil prices. All these things have an impact on stock markets. So things like the COVID-19 breakouts, Trump Tr. Adkey with nuclear war treats from * terror's attacks. All these things cause uncertainty, and the stock market don't like uncertainty. So headlines like this can often cause panic selling and quick big drops in the market that literally reserve just as quickly. So geopolitical events can often be opportunities to buy stocks really cheaply. Another factor is human emotion. Just fear and greed, and we are all guilty of this. Sometimes market just go up on pure speculation, aka greed, even though there isn't really any economic growth or dollar to back it up. There's always gonna be some idiots who's willing to pay a lot on the odd side, another idiot will come up willing to pay even more. Bitcoin is a classic example of a speculative market. Prices go up like crazy because everyone thinks they're gonna get rich overnight, and this speculative bubbles burst just as quickly. We all know what happened to Bitcoin prices this year. The flip side of greed is fear. The market can drop really quickly when everyone is scared, panicking, and the attitude is just suffers to ask question later. You never wanna sell your stocks at times like this because it always gonna be the worst possible moment. Panics are always temporary, so you wanna let the market come to its senses, let prices recover before you make any big decisions. Intrusive, the stock market has been on a major winning since 2008, making records high and making a lot of people rich. At the same time, interest rate has been on their lowest levels in history, close to zero. This is not a coincidence. When rates are low, that makes it easier for people to buy things on credit, for companies to finance new projects, create jobs, and there's just more cheap money for everyone all around. This helps the economy, which turns helps the stock market. So in general, low interest rates are good for stocks. High interest rates are bad for stocks. Interest rate in the US are set by the Federal Reserve, aka the Fed. The Fed meets 8 times a year, and market moves in anticipation of what it expects the Fed to do at these meetings. So if the market thinks the Fed is going to cut rate at the next meetings, market will rise, and if the market thinks the Fed will raise rate at the next meeting, the market will drop. The 5th and final factor is money supply. Since the Fed controls the money supply, it can also literally print more US dollars as well. Around 2008, when the stock market was more profitable, the Fed has been printing trillions and trillions of dollars to keep the interest rates super low. And this boosts the stock market in a major way. Why? Because printing money increases the amount of money in circulation, so there's loads of money that needs to find a home, and all this money is pumped into the stock market and other kinds of assets, driving prices up. So there you have it. Now I have a question for you. What's the most confusing part about investing for you? Let me know by contacting us below, and let's get this discussion going. Please share this video so that we can empower even more people with the financial literacy and encourage the need to live lives on their terms. Thanks for watching.